have a very full slate of corporate news in the coming week, so we're going to put aside the macro on this occasion, not least as it's relatively quiet on that front. Although, do watch out for UK unemployment and wage growth on Tuesday the 16th, and the latest consumer confidence survey for the UK from consultants GfK on Friday the 19th. On a less parochial note, the latest G7 meeting will take place in Hiroshima, Japan, and the opening day of that jamboree is Friday the 19th as well. Company-wise, more than a tenth of the FTSE 100's constituent firms are scheduled to release results or a trading update in the week ahead, so investors will have plenty to ponder, especially as a good range of mid and small cap firms are slated to do the same. There's also a long list of annual general meetings, or AGMs, and they could come up with a trading update in tow, so keep your eyes peeled there. And do note, however, some of these dates could yet still be subject to change. Currys on Monday the 15th of May, Vodafone, Imperial Brands, DCC, Land Securities, Britvic and Greggs on Tuesday the 16th, British Land, Sage, Experian, Anglo-Asian Mining and Coates on the 17th, Burberry, Convatec, Premier Foods, EasyJet and Future on the 18th, and Smiths Group and Young's Brewery on Friday the 19th of May. But the company which could really cause a fuss in the week ahead is BT. The telephony, broadband, mobile and TV services provider will publish its full year results for the year to March on Thursday the 18th. The shares have actually had a good run since January, but despite that 40% advance, they're still down by around a tenth over the past year. And to take a long-term look at it, the picture's even worse. BT shares are trading no higher now than they did in 1985, in the first year of its privatisation under the Thatcher government. The reasons behind that run are not easy to find, or at least the good run are not that easy to find, although bid speculation could still be one of them, thanks in part to the 18% stake in BT held by French telecom magnate Patrick Drahi. And also, there has been merger and acquisition activity in the telecoms industry worldwide, although whether the UK government would allow anybody to bid for BT remains an interesting question. In addition to that chatter, the company has also clinched BT Sport's merger with Discovery's Eurosport UK, targeted an extra £500 million in cost savings on top of the £1 billion already made, and there have been no additional profit warnings in the past year, so no news has been good news there. Higher interest rates and bond yields have also helped to reduce the pension deficit. That said, February's third quarter results statement was pretty uninspiring, and it did acknowledge that earnings will be more back-end loaded into the final 3 months of the year than normal, thanks to front-end loaded capital investment and back-end loaded revenue collection. These results, and any guidance given for the year ahead, will be judged against the 4 key items of guidance given by boss Philip Jansen a year ago, namely, growth in adjusted revenues, earnings before interest, taxes, depreciation and amortization, or EBITDA, of at least £7.9 billion, capital investment of £4.8 billion, and free cash flow of £1 to £1.3 billion. Analysts have penciled in the following for those 4 headlines. Headline sales of £20.5 billion, down 1.6% year on year. Analysts will also look for any guidance for the new fiscal year to March 2024, when the current consensus is looking for a 1.5% increase in total sales to £20.8 billion. The consensus forecast for BT's preferred profit metric of EBITDA is £7.9 billion, a 4% increase and smack at the bottom end of management's guidance range. For the coming year, analysts looking for a 2% advance to £8.1 billion. Capital investment of £4.8 billion to £5 billion compared to £4.8 billion a year ago, and the consensus is looking for a retreat back to £4.8 billion in the coming 12 months. And analysts think that the free cash flow number will come in at the bottom of the targeted 1.3 to 1.5 billion range. That in turn leads them to expect an unchanged full-year dividend of 7.7 pence a share, and that costs around £750 million a year. Free cash flow cover is therefore less than 2 times, which suggests scope for dividend growth in the coming year is limited unless something improves pretty fast. BT's balance sheet's also a factor. It ended the last fiscal year in March 2022 with net debt of £12.7 billion, lease liabilities of £5 billion, and a pension deficit of £1.1 billion. Although the pension scheme has become less of a burden, those 3 items came to £18.8 billion, That's more than BT's current market cap of $15.5 billion, and that's something that any predator would have to consider were they to make a bid, as it would have to take on those liabilities when they buy the assets. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.